A stock doesn't jump more than 50% intraday because it suddenly became real. In a Nasdaq microcap, that kind of move is often the market reacting to structural pressure, not celebrating fundamentals. The drivers are usually the boring, dangerous ones: listing compliance, capital access, dilution math, and the uncomfortable truth that sometimes a company's most valuable output is runway. This story is about Nauticus Robotics, Nasdaq, KITT, an American subsea robotics and autonomy software company. Offshore subsea work is expensive, risky, and operationally unforgiving. If autonomy can reduce vessel days, human exposure, and the cost per underwater intervention, it can reshape offshore economics. Nauticus sells that promise through three offerings. Aquanaut is its autonomous underwater robot for subsea missions with reduced human tethering. Toolkit is its autonomy software layer, positioned as a modular kit that can be deployed not only on Nauticus systems, but also on third-party work-class ROVs. Olympic Arm is its electric subsea manipulator, positioned against traditional hydraulic manipulators for complex precision tasks. Investors care about this stack because hardware-heavy robotics tends to scale slowly and burn cash, while software, if broadly deployable, can scale faster and potentially support higher margin, more recurring revenue. Toolkit is the hinge. If it truly spreads across platforms, the business model can shift from project-driven hardware economics toward platform economics. But the snapshot numbers put the thesis under financial gravity. KITT was shown around 1.1 per share, up roughly $0.4 on the session, over 50%, with an intraday range around 0.7 to 1.2. The 52-week range was shown from roughly 0.7 to roughly $54, the kind of discontinuity that often reflects corporate actions and microcap liquidity-driven repricing. Market cap was around $15 million. Trailing 12-month revenue was around $5 million. Trailing 12-month net loss was around $110 million. When losses dwarf revenue, external capital stops being a side story. It becomes a core driver of outcomes. The stock becomes a vote on ownership math as much as a vote on technology. That sets up the fundamental mystery. Why can a microcap rally hardest when dilution risk appears to rise? The answer is in sequence, and in what is normal versus unusual. On September 2nd, 2025, Nauticus announced a 1-for-9 reverse stock split. In typical healthy company situations, you see forward splits 2-for-1, 3-for-1, after strong runs to keep the share price in a convenient band and broaden liquidity. Reverse splits are usually